Welcome to The Explainer. Today, we're taking a completely data-driven look at how everyday earners can actually protect their money from inflation starting right now. And look, I was honestly blown away when I dug into the hard math on this because we are totally skipping the hype today. We're looking at what genuinely helps normal, hardworking people guard their wealth against rising costs.
So let's jump right in and start with a pretty massive question. We hear the conventional wisdom constantly, right? Buy gold, buy crypto, become a landlord the absolute second inflation hits. It sounds fantastic, and it certainly feels protective. But what if that popular inflation advice is actually destroying your wealth? Because for the average earner with a regular job and limited capital, a lot of these trendy strategies are just completely wrong. They could literally be actively working against your financial goals.
Section 1. The false inflation hedges. Let's look at what definitely doesn't work.
Okay, everyone tells you to rush into gold when paper money starts losing value. But the math? It tells a very different story. Now, gold isn't a scam, but it really only preserves your wealth instead of actually building it. If you look at a 50-year horizon, its 7.3% return lags way behind broad market equities. It does exactly what it's supposed to do, store value. But when you compare that against the S&P 500's 10.5% return, you see this vicious, massive compounding gap forming over the decades.
Here's why that matters. If you're a regular earner, you just can't afford to merely preserve your wealth. You desperately need it to grow. $100,000 in 1975 becomes a totally respectable $2.1 million in gold, sure. But in the stock market, over $11 million. So the opportunity cost of just hiding your money in gold is absolutely catastrophic for your long-term wealth.
Right, so let's look at the modern version of gold, crypto. A ton of people tout Bitcoin's fixed supply as the ultimate shield against money printing. Well, let's rewind a bit to 2022. US inflation hit a 40-year peak of 9.1%. This was it. This was the moment an inflation hedge was supposed to step up and do its one and only job. And what happened? In that exact same year, Bitcoin plummeted by over 60%. It turns out it acts a lot more like a highly volatile risk asset than a reliable shield. I mean, it collapsed at the absolute worst possible time because it moves with the broader risk appetite of the market, not as a safe haven. It's not exactly the bulletproof lifeboat everyone was promised, is it?
Section 2. The rental real estate trap. Why the math usually fails.
We see this dream of passive income all over social media all the time. But say you buy a $400,000 property. The influencers conveniently ignore reality. That $2,200 rent check sounds absolutely amazing until you start subtracting the mortgage, the insurance, the inevitable repairs, the management fees. The hidden costs pile up remarkably fast.
And the final math is honestly brutal. Instead of building some massive empire, you're carrying a negative cash flow and essentially subsidizing a complete stranger's lifestyle. You could easily be out of pocket by over $1,200 every single month. You haven't bought an asset. You've basically bought yourself a second job that comes with huge legal liability and highly illiquid capital.
Now, people always bring up the tax benefits. But here's the catch. To get those unlimited passive loss deductions, the IRS requires you to spend over 750 hours a year in real estate activities. And it has to be more than half of your total working time. That completely excludes almost everyone with a full-time W-2 job. So you're taking on all the headache with none of the actual structural advantages.
Section 3. Reliable wealth protectors. What actually works?
Let's pivot away from the hype and look at the boring, unglamorous tools that actually do work, starting with I-bonds and TIPS. During that massive 2022 inflation spike, I-bonds perfectly matched the moment. When inflation hit 9.1%, the I-bond rate adjusted to over 9.6%. It was a perfect mathematical match. Now, they aren't meant to make you rich, but they are absolutely the best place to park the cash you cannot afford to lose to inflation.
Next up is your primary residence. Now, this one might surprise you, but the Schiller Index shows that real home price appreciation since 1900 is practically zero after you account for inflation. It literally hovers right around this tiny 0.6% mark. So your house isn't actually a magical wealth-building machine in real terms.
But homes preserve wealth beautifully. Why? Because if you use a fixed-rate mortgage, your housing costs shrink in real terms every single year that inflation runs hot. Think about it. Over 20 years, a steady 3% inflation rate takes a $2,000 monthly payment and shrinks its actual burden on your wallet to just about $1,107 in today's purchasing power. Your payment is frozen in time, but inflation makes the money you use to pay it worth less. It's brilliant.
Section 4. The true growth engines. Accelerating your wealth.
Okay, this is where we stop playing defense and start playing offense. We know inflation crushes some businesses, but companies with real pricing power, think giants like Costco, Visa, Procter & Gamble, they just simply pass those costs right on to consumers. If you own a piece of businesses that consumers rely on no matter what, their revenues automatically scale up right alongside inflation. They are inflation's true winners.
But here is the major trap. While broad equity ownership in the S&P 500 historically dominates inflation, everyday investors constantly destroy their own wealth. Over a 20-year stretch, the market delivered around 7.4%, yet the average investor only captured 3.6%. The system works perfectly, but human emotion, panic selling when the news looks scary, is the ultimate wealth destroyer.
Section 5. The ultimate inflation strategy. The number one hedge.
So, we've made it to the grand reveal. The number one strategy, and it's likely hiding in plain sight in your monthly budget right now. It is exactly what Wall Street does on purpose. They use long-term fixed-rate debt to literally short the dollar while their assets grow. You borrow money at a locked rate, you let inflation melt away the real value of what you owe, you watch the underlying asset grow, and you simply pocket the difference. It's a proven formula for wealth, and you can do exactly the same thing.
When you hold a 30-year fixed-rate mortgage, inflation is quietly destroying the real value of your debt. That means you are paying the bank back with dollars that buy less and less every single year. You essentially borrow highly valuable $2024 dollars today to buy your house, but you hand the bank back significantly weaker, cheaper $2034 and $2044 dollars in the future. You are quite literally shorting the US dollar with your very own house.
So instead of aggressively trying to pay off your mortgage early, redirecting that extra capital into equities captures a massive wealth-building spread over 30 years. Let's say you throw an extra $500 a month at a 6.5% mortgage. Well, you're locking in a 6.5% return. But if you take that exact same $500 and put it into the S&P 500, which historically returns around 10%, you are capturing a massive positive spread. Your debt is getting cheaper, and your wealth is accelerating at the same time.
But listen, there's a huge catch here: discipline. Before you go out and try this, remember that the math only works if you stay incredibly behaviorally disciplined. You need to keep a rock-solid emergency fund, and you must actually invest the freed-up capital. You cannot just go spend the difference on a new car or a lavish vacation. You also need a mortgage rate that sits below those historical equity returns. And obviously, this is a bit less optimal if you were just a few years away from retirement and you're prioritizing total peace of mind and debt elimination.
So, as we wrap up this explainer, you really have to ask yourself a question. Are you ready to just let time, compounding, and debt erosion silently build your wealth in the background? The most effective financial strategies aren't dramatic. They don't make for flashy viral videos. They are structural. So, are you going to keep chasing the flashy trends, or are you finally ready to use the math to your advantage?